Welcome to the TBD podcast.
Excited to be here. Oh my God.
This is very exciting. I mean, we've been friends for how many years now?
11?
11
years. Who would have thought a chance meeting on a Target in Ithaca, New York would result in us being here?
I remember. And then the first semester of that year at the hotel school in Ithaca, Cornell, you didn't come out of your room.
I was terrified. Honestly, like you did terrify me in many ways, but I'm glad that you persevered and got me out of the room. And it was really cold too, right?
It
like
was
after
very
the summer,
cold.
it got really cold, and then it was like, what am I doing here?
Well, I took you out one time, and I think I broke the seal. And then you realize there's more to life than studying. But you know what? That's what got you to first in the class, right? So
that's really nice. I don't think I was first, but I'll take it. I'll take it.
So I thought maybe we should introduce ourselves a little more formally first.
Sure.
Zach, do you want to do the honors?
Wow. All right. I'll try. But yeah, no, I agree. It feels like it's a long time coming, but we've also talked about it in different iterations for the last decade or so. But yeah, I mean, I am a hotelie through and through. Before meeting you at the hotel school, I went to Boston University, graduated, focused on hotels, and then I worked for Marriott for about a decade. I was with the luxury group. Originally, that was just Ritz-Carlton. Then Marriott fully acquired Ritz-Carlton. It became Ritz-Carlton and Edition. Then Marriott bought Starwood, and it became Ritz-Carlton Edition W and St. Regis. I was focused on revenue management, corporate strategy, and hopefully it comes across, but I love hotels. For better or worse, I love hotels. I think they're such complex, interesting asset classes. Obviously, we'll dive into it, but the operations, the branding, and then, of course, the real estate. After Marriott and after, of course, us meeting at the hotel school, I went to work for JLL, where I led the global hotels research and strategy team based here in New York City. We did a ton of work with institutional investors, brands, private investors, you name it, across the hotel and broader hospitality space.
Yeah, and then because of that role, you have a much bigger advantage than me on these podcasts because you've done at least 2,000 of these.
Ooh, I don't think that many.
And I think I'm in the single digits. So.
Yeah. That honestly, the first few I did it's awkward. And I'll be honest. I mean, we should be honest. It is awkward in many ways. But no, that was a really fun role, like doing podcasts, speaking on panels, talking to investors. And I think that's really where I develop more of that love for the real estate piece, right? Because hotels, we'll talk about it, but hotels are complex in that sense that they are distinct between the real estate and the operator, but of course you need both to be successful. So I spent a number of years at JLL, and then I left and joined 8Form, a hotel owner-operator that has about $1 billion in hotels under management, and I lead the asset management team there. And so I've had a chance to take everything I learned from Marriott, from the operator side, from JLL, from the real estate side, and marry the two, focusing on how to drive returns from a hotel investment perspective.
You're a true hotel guy. You are a true hotel expert.
True hotel guy, which I know you've had the advantage of working in other industries, so you can. That's why I think we can counterpoint each other.
Yes, I've dabbled in other things as well. So I started my career at Goldman Sachs in the merger and acquisitions, real estate group, investment banking. Did a couple years there. Then thought I wanted to own hotels and restaurants straight away. This is when I was a mere 22, 23 years old. So went back to Cornell to do the 1-year master's in management.
Wait, were you 22 when you got there?
I was trying to make myself sound younger and more impressive.
You could.
More impressive.
I mean, yeah.
So obviously we met at Cornell. While I was at Cornell, the related companies came and presented on Hudson Yards, and I thought the vision was extremely interesting. So I was introduced to our head of international development, who recruited me, I'm sure because of my accent, to help Related build the London business. So I joined Related, went into the development team based in New York, traveling back and forth from the UK, helping them on their big mixed-use projects in northwest and northeast of London. After a couple of years, leadership gave me the opportunity to move into the New York development group. So I said yes and thank you. At a time when the market was a little frothy, as was 2018, 19, but still there's a lot of amazing things that Related was doing. And so I was very fortunate to be put on to the 35 Hudson Yards, which was the first Equinox Hotel flagship project with condos, office, retail intertwined. And I led that from really cradle to grave, so from financing all the way through disposition last year. In addition to the Equinox Hotel, I helped to build a couple of other luxury development projects in the city, predominantly residential, and then a few of our conversion projects.
But let's be honest, Hudson Yards is transformative, right? Like I remember you were one of the people that told me about it earlier on, and there was a lot of questions on whether you could transform that part of Manhattan. And And you guys did it, right?
It's done extremely well. The hotel now, I mean, we always position the hotels between the lifestyle set and the luxury set. And at the beginning, it did perform in terms of rate and occupancy right in that middle, but has slowly over time, before we sold it, climbed up to almost match the luxury rate. So we were very happy with its performance. And then Hudson Yards in general was transformed to this amazing tourist destination where a lot of people call home. So it was a wonderful journey. But then, but then I thought, I love hotels too much. Let's launch an investment firm. So TBD Companies, we invest in premium select service and compact full service lifestyle hotels in high barrier entry, primary, suburban, secondary, urban cities. We'll get on to talk a little bit about what all of that gobbledygook means to our non-hotel,
for the non-hotel folks,
folks. But we wanted to spend today, I think, about first topic to introduce the company, of course, and then also just talk a little bit about why we love hotels, why we always love hotels, and why we love them in particular in today's world. So do you want to begin and just talk a little bit about, I said premium select service, compact full service, I said a whole bunch
all
of
the
words.
terms that we...
want to contextualize that in terms of the other categories in the hotel?
Yeah, no, I think it's fair. I mean, listen, I think, whoever's listening, everyone's probably traveled in some sense in their lives. The reality is that in the U.S. is about 65,000 hotels, and people think of hotels, typically think of your roadside hotels all the way up to luxury. And the industry splits them into 4 or 5 different classes. So towards the bottom, you have the economy hotel. And again, that's typically your, roadside hotel, your very straightforward box. It doesn't have any frills. It's really just focused on location and price. We would say it's a very commoditized space. Again, there is a traveler for that, for sure, but there's nothing specific drawing them to that hotel. They're being drawn typically, again, by location and price. That's really not the space we play in. And then if you were to leapfrog all the way to the top, you have your luxury hotels, right? So you can name all the various brands, Ritz-Carlton, Four Seasons, Aman, et cetera. And clearly that caters to a very specific traveler. Those hotels, again, are fascinating. They are much larger, much more complex. And from an investment perspective, the reality is that to make real investment returns, you have to hold them for 7, 10, 15 years often because, again, the requirements. And so that's really not a space that we play in either. I would say we play more in that middle, gearing closer to luxury than economy, but again, more in that middle. And so we talk about select service versus full service. Select service hotels, by definition, are ones that don't have multiple revenue outlets outside of rooms, right? So most people think of a hotel, you have your room, you have a restaurant, you might have a spa, you might have something else. Select service has your room, may have 1 restaurant, maybe 2, but it's very straightforward, not necessarily super flashy. Again, it's really based on function. Full service hotels are the ones that have multiple restaurants, typically have a bar, might have a spa. We typically say it's 2+ revenue sources outside of rooms. And so within the select service space, again, you have your commoditized hotel, as I spoke about, and then what you have is your premium hotel. And again, those are hotels that cater to more diversified demand. It's not just looking based on price and location. It's something more, something that the hotel intrinsically offers. And for us and for TBD, I think that's where we see the opportunity, again, to create that diversification and differentiation without it becoming more complex in ways that might require additional capital expenditure. And then on the full service side, again, you have luxury all the way at the top. Beneath luxury, you have these big box hotels. You think of hotels like Gaylord, like convention hotels. Again, these are 600, 700, 800 room hotels that have multiple revenue sources, typically really rely heavily on meetings and everything else. Again, an interesting space, but not a space that TBD plays in. We would say we play in the space next beneath that. It's not necessarily lower class. It's just more compact in the sense we wouldn't go typically above that 220 room threshold. It has some differentiation with food and beverage, maybe spa, maybe parking, something else, but we're not talking about these highly complex
Which
hotels.
is interesting, right? I mean, if I'm talk about multifamily or office for a second, you have Class A, Class B, Class C, and both of those asset classes, but it's simply that. And you have all these different categories of hotels, which if you can become an expert and understand how they all play together versus the macroeconomy versus the microeconomy, you can create an outsized alpha.
100%. And I think that's a really good point, right? I think people, if you have some real estate exposure as an investor or even as a consumer, right, you typically think of better amenities must mean better. And that's in I'm not an expert, but in the office and retail, my understanding is that's typically how it works. Hotels is not necessarily the case, right? If you look at a Ritz-Carlton, it is a luxury hotel, and so it has, maybe a nicer room, more amenities. But it doesn't mean it's necessarily better. It depends on the consumer that you're trying to attract. It's definitely going to be more expensive. And from an investment perspective, it's going to be a lot more complex. That doesn't mean it's better. And in some ways, you could make the argument that select service in that premium space, which has some differentiation, is better. It just, again, depends on who you're trying to attract.
And talk a little bit about the size of the market. Like, do we have 2 hotels to choose from here nationally, or what? Talk a little bit about the size of the audience.
Yeah, so I mean, there's about 65,000 hotels in the U.S. If you look at that premium, select, and compact full-service space, it's give or take about a third of the market, and we're talking about $260 billion of investable opportunity. So by no means is it small. Again, you think about the brands that make up this space, just to name a few, AC by Marriott, Courtyard by Marriott. In that lifestyle space, you have JDV Hyatt, Hilton has Tapestry, Marriott has Tribute. And again, we can get into what all these mean as we kind of evolve, but the reality is that it's a huge space with multiple different consumer segments.
So that's great. There's also one other distinct differentiation here, which is in the multifamily space or the office space or the industrial space, there's a landlord-tenant relationship, and it's typically just me versus you or me with you, hopefully. Whereas in the hotel space, you have this interesting 3-stakeholder dynamic, right? You have the owner, the brand, and the manager, which again, if you can navigate the 3 of those properly, you can create real alpha. Do you want to talk about how typically you think about those relationships and how they intertwine?
Yeah, no, I think it's a fair point, right? I think if you look at other real estate asset classes, to your point, they are built on long-term leases, right? And you can probably speak to this better than I can, right? But 10, 15, 20 plus year leases between the owner and the tenant, or on a multi-space, the tenant being an individual. Hotels don't have that, right? People travel in hotels. The average length of stay is 2 nights, right? So in some sense, you and I were at a conference the other day, we heard this, right? In some sense, you're negotiating leases on a daily basis because there's individual travelers. Now, the traveler is choosing a hotel typically based on the brand, right? So if you pick biggest hotel in New York City, the Marriott Marquis in Times Square, it's a Marriott. So the traveler is typically booking that hotel because Marriott's on their door. They're using the Marriott app or anything else. The reality is that hotel also is owned by, in this case, owned by a REIT. The consumer doesn't know that, but that's who controls the real estate. That's who controls what the room, the degree to which there's investment, the degree to which the restaurants change over time. But then there's actually a different entity that's operating it. Again, the consumer doesn't know that. The consumer thinks it's Marriott. By and large, it's not. There's 200 or 300 third-party operators out there. But the reality is all those three components have to play key and differentiated roles. And from an investment perspective, you have to find a way to bring them in balance. And it creates complexity, but again, to your point, it really creates opportunity.
You mentioned briefly at the start of that response about the daily repricing, which I think you can get a lot of non-hotel investors to say that's a disadvantage. Sure. Whereas really, in our opinion, that can be a real advantage. Obviously, it comes down to timing to some degree, but if you're in good times, you can sprint on the upturn. But also, if you're if you're in a bad economic cycle, assuming you have a strong brand, you can hold your base rate firm. Assuming you have diversified demand drivers in the hotels you invest in, you're protected in that regard. So there are many different levers you can pull to protect yourself in the down cycle. And then hotels are always the first to sprint and react quickly on an upturn, which is an advantage.
Yeah, I'm sure you saw it at your time with Related and Equinox, right? To your point, and that's a premium positioned hotel in a city that has plenty of premium inventory. And yet, post-COVID, when there was this built-up demand, right, travelers, we called it revenge travel, hotels were the quickest industry to recover, right? Hotels saw this RevPAR growth, and RevPAR is revenue per available room. It's kind of a way to approximate occupancy and average rate. But we saw this insane recovery, right, from a period in which there was basically no travel. So yeah, I mean, I think people look at this kind of daily lease and this daily repricing as a risk. And in many ways it is, right, because you have to consistently negotiate. But if you look at over the last 20, 30 years, whether it's post 9/11, post GFC, and post COVID, hotels were impacted the most, but were by far the quickest to recover. And that impact was somewhat mitigated. And I think that goes back to the segments that TBD is investing in, is we look at things that have differentiated demand. So you're not 100% reliant on that traveler that books for leisure, right? Leisure travel is somewhat, in some ways, the most fickle because you're relying on that discretionary spend. there's business travel, there's group travel, there's all these other things that in softer economic markets you can really protect against.
Exactly. So just to switch topics to everyone's favorite for a second, which is cap rates too. So if you
it's your favorite topic, actually. Yeah.
if you're thinking in terms of structurally, how do hotels trade versus other asset classes? Yeah. Hotels will typically trade, I think, as multifamily and industrial. They trade at 300 basis points premium, and to office 150, 200 basis point premium. And that's because the industry views it as more complex. But if you're
riskier to some degree,
correct. But if you're an expert, it doesn't actually cost you 300 basis points of complexity. So I think there's a real opportunity there to make an outsized return if you know what you're doing in the hotel space.
Yeah, but I guess to that point, right? I mean, you have more experience looking at different asset classes. Like, that risk is baked in because of the operational complexity.
Correct.
But if there's a way, if you understand what the differences between the different operators are, the different brands are, you can really offset that risk.
And I can make a strongish argument for let's just take Class B multifamily, for example. I buy a Class B multifamily asset for, I don't know, a 6.5 cap, okay? Yeah. And my business plan, which a lot of these Class B multifamily business plans are, is that I'm going to do some renovation work. I'm going to try and hike the rents so that I can now charge rents that are still at a discount to Class A, but now I'm getting a premium to what I bought at. And maybe I'm squeezing out a 6 cap on the other side. There is inherent risk on the operations side executing that business plan.
Sure.
But you're buying that asset and stabilizing it in the 6 caps versus hotels, right? Which you're getting a stronger yield out the gate. Yes, you're relying on some operational expertise to execute the business plan, but inherently, if you do it well, which we will do, you can get higher returns over the same whole period. So there are inherent risks, obviously, in any asset class you invest in, and especially in the multifamily space, where now, because it's been such a popular investment class from 2010 through 2019, we have also a supply issue now in that market where you're paying these incredibly compressed cap rates and coming out the other side, if you're lucky, at the same cap rate and still having to execute a complicated business plan. Whereas hotels, it feels like more of an ability to create the alpha.
I agree. Yeah, no, I definitely agree. And I think hotels historically have been looked at as an alternative asset class investment within real estate. If you look over the last 20 years, hotels globally make up a proud 5% of overall real estate capital investments. That number has increased each year, but it's still, I think it's sub 10% today.
Right.
But again, I think that goes to your point, right? They're complex assets, they're operating assets. But the reality is that cap rates have historically traded at a premium for hotels to bake in that risk. But if you said it really well, if you understand the complexity, you get that 300 basis point premium, and you don't have to have 300 basis points more of complexity. You just have to understand how to execute across the board.
Exactly. And then the last point I think I want to bring up in terms of why we like hotels, just structurally speaking, is that consumer spend as a proportion of everyone's budget, and also of everyone's discretionary budget, has gone up massively in comparison to the other discretionary spend categories of the last couple decades.
Right.
And I think there's, especially coming out of COVID, a very strong argument to say, is this even discretionary anymore?
Yeah.
Like, I know that when I'm looking at my bank account and my budget every year, I'm like wanting to cut things. Travel's like one of the last thing I want to cut.
Yeah.
And I think in this environment and world that we live in, especially with kind of the lack of community, more automation, advent of AI, of course, that desire to travel is only become stronger and stronger, which is only going to be better and better for our business. So I think we have a huge advantage in the hotel space to capitalize on that trend coming out of COVID. I think it's a trend that's only going to get stronger over time. And especially where we play, maybe it's not the luxury space. We can get on to say why that's a great space and why it's not such a great space. But in our space, we're offering those differentiated experiences. We're not just buying a commoditized box here. We're buying a box with great F&B, with good meeting space, diversified demand drivers. So we're going to be able to take advantage of that trend over time.
And I think you said it, people want to be together. And the reality is that travel is the best facilitator for getting people together. And I think the other thing to keep in mind, and another reason we play in this space, is that hotels are not just places to sleep, right? Clearly, room revenue in the hotels that we look at is 60, 70% of the mix. So it's hyper important. But the best kinds of hotels are ones that are integrated in the local community in a way that locals want to go there, whether it's to the bar, to the restaurant, if you have a spa, even just community in sort of a lobby area. And so I think, again, that really speaks to what hotels have become. And travel, I would agree, it is considered a discretionary expense. But if you look at the portion of spend on travel relative to other discretionary expenses post-COVID, it's from 30 or 40%. So it's really hard to argue that it's discretionary in some senses. And I think people want to travel, want to experience other cultures, want to see friends, family. And so I think the space will just continue to grow.
No, I totally agree. So let's shift a little bit and talk about why do we like hotels, especially in this environment?
Yeah, why now? Yeah,
why now?
You tell me. I'm serious. Like, why? Yeah, what about today is so? Because hotels have been around since, I don't know, thousands of years, the inns, right? So, like, what is so special about today's one?
I think there are a few points here. So, no particular order. I think the discount replacement cost today is quite extraordinary in the hotel space. I think you could probably make that argument across asset classes, but especially in the hotel space. Since 2019, pre-COVID, construction costs have gone up by almost 50%.
Wow.
Of course, inclusive of Trump's tariffs. Intertwined with that rise in construction costs, you have all the uncertainty about where costs will go. And so,
and I have to assume labor is tough. Construction labor availability.
Correct. Yeah. It's all baked in, construction labor, everything. And so, of course, when it's unaffordable to build anything really at this point in time. So there's a real advantage to buying existing assets at a discount to replacement cost and getting it at a great basis. And then, along with that very favorable supply-demand story, you have the opening up of the debt markets. Since 2024, you've had, I think the Fed's dropped rates by about 200 basis points.
Wow. Yeah.
So there's actually a lot of liquidity in the market now.
And I think it's important, to contextualize that, in the height of COVID, debt was essentially free, right? I mean, interest rates were at their lowest point in basically our lifetimes, our investable lifetimes. And then you had this increase of massive proportions. While debt rates never reached the levels that they did, in the 80s or 90s, the rate by which they increased was higher than ever. So to your point, we're starting to see this decrease. We're starting to see a lot more liquidity.
And I would say too, we talked about cap rates in the hotels being between the 9 and 10% yields stabilized. Stabilized is just debt today all in, let's say 6.5%. We have positive leverage. Last time you compare that to other asset classes trading at 6%, it's
you're still underwriting negative leverage,
etc. Right. So there is a real ability to get these deals financed in a very favorable fashion, which is great. And to deal with the uncertainty, of course, you have to be very sensible about the leverage you're taking, 55, 65%
and very disciplined.
Leverage.
Right, exactly. But I want to go back to what you said about construction costs being at basically all-time highs relative to acquisition costs and what that's doing to supply. Like, can you talk a little bit about
I'll talk about, as a developer, I'll talk about on the residential side, and then we can talk about on the hotel. But the residential side, we're underwriting deals just trying to scrape out a 6.5, 6.75 yield on cost out the gate.
Wow.
And then you have to execute perfectly on that business plan, hope the cap rates compress on the other side, and you're selling sometime in the sixes in order to get any kind of return which is attractive to your LP base.
Right.
That is... Talk about risk.
Yeah, I was going to say.
Talk about risk, ground up development. That doesn't work. It doesn't work with hotels either. And guess what? Even if everything changed tomorrow, it would take 5 years to build a courtyard, right? So we have this amazing runway now, the supply runway, which we can really take advantage of. And by the way, costs don't just go down, right? GCs hold their costs. So I think we're in a period of time where this is what things are going to cost, and until rates can catch up with the costs and exceed them, it's not going to make sense to build anything. So I think we have a 5+ at least runway here to take advantage of the current market and buy things at very attractive replacement cost bases.
Yeah.
And as long as you have a team, which we do, to be able to execute on the operational business plan, you can make a real alpha.
And I think that's a really good point, right? Because if you think about the hotel space, right, you have, like any industry, you have supply and demand. If supply is stagnant, and even if demand stays stagnant, which I think we both believe it will continue to grow, as it has basically every year over the last 20 years, that means immediately you're going to get that occupancy increase. And if supply in your market is broadly stagnant, you have rate opportunity.
I think you have, right, 0.7% supply growth projected from 2024 to 2028. And we know that with that kind of supply growth, you get outsized RevPAR growth.
Yeah.
You see it, interestingly, too, just separately. I mean, in New York City, which is where I've worked for the last 10 years, you have this special permit now.
Oh, the regulations.
The regulations, which are even preventing you from building hotels beyond the construction cost issues, etc., in favor of building more housing. So I'm actually curious, as a further impediment to future building nationally, we know there's a conversation about building more housing.
Yeah.
Like, how is that going to affect the building of more hotels nationally,
Totally.
perhaps in regulation, especially in the blue states? So that's something to consider also in the supply.
And we also see that even in non-blue states, in suburban areas, you see that commoditized product being converted into housing, right? Like that, the extended stay Americas of the world, the et cetera, right? That were built to be housing replacements. And the reality is these markets don't have enough housing. And so what does that do, right? So it's a challenging construction environment. In some cities, particularly regulatory, it's impossible to build. And then you have some hotels being converted into other uses. So again, I think from an operations perspective, that creates real opportunity. And then obviously from an acquisition perspective, knowing that today and really over the last couple of years, and likely this is a relatively short-term dynamic, you can buy at 30, 40% less than would otherwise take to build. And that creates real arbitrage.
So let's be intellectually a little bit honest here, though. Okay, so we're talking about high construction costs and all this stuff, right? Let's not pretend that let's not forget about PIPs.
Sure,
Property
and
improvement
hotels
plans, right? Property improvement plans.
Intensive.
If you talk to a hotel person, talk to a non-hotel person, we don't love PIPs. They cost a lot of money. Of course, they've been impacted by these rising construction costs. You're typically buying these hotels from investors who've held their assets for at least the period of time which a PIP is now required.
Yeah.
So you're taking on that obligation, which is both a positive and negative, because
you get some value opportunity.
There's a motivated seller who wants to sell you because they don't want to do the PIP, and you're buying it at a discount because of that, but then you have to execute on the PIP. So that exists, however, on the other side, right?
Flip the counter.
On the flip side, these brands, I think, more than ever, seem to be providing available key money.
Yeah, I mean, so again, going back to that sort of three-legged stool, for lack of a better term, right? So you have the owner, they own the real estate, they own the building. You have the operator, they manage the employees, and then you have the brand, right? The brand is the flag, and ultimately that's what the consumer is buying. Historically, over the last 20, 30 years, the brands have made a concerted effort to be what they call asset light. They don't want to have any equity stake in the actual building. They really just are fee generators. They're distribution engines. They collect, depending on the brand, 3 to 5 to, in some cases, as high as 11% of gross room revenue, basically as a franchise model. However, because of this challenging construction environment, the brands aren't able to grow the number of flags, the number of hotels they have. If you look at their share price, the way that the brands make money is they either grow same store revenue, right? So they could just get same percentage of higher amounts.
Okay, you're going to weave in the public company
situation,
right?
Yeah.
Like a lot of these Hilton, these big brand companies are public companies.
They're all.
How do they move their stock? They have to increase.
They have to increase their right. So what their biggest metric is what they call NUG, or net unit growth. So it's just adding new hotels. Great. Yeah, exactly. NUG. So I'll just say NUG consistently. But yeah, so they have to add new hotels. Historically, that's done through development, right? There's in the average year, there's 100,000+ new hotels open, give or take. And the brands roughly equally split them, some level of independence, and the rest are split between Hilton, Marriott, Hyatt, and IHG. In today's environment, there's so few hotels opening, the brands really have two options. They can go out and buy other companies through M&A, which is expensive. There aren't that many hotel companies to buy. You've seen it, right? Marriott bought Citizen M last year. Hyatt bought Standard. So it happens, but again, that's not a huge accretive number. The other way is to help facilitate transactions. So a hotel is sold, it's a Hilton, and that the new owner terminates Hilton upon time of acquisition and converts it to a Marriott. But to your point, that requires capital investment through a PIP. And so what the brands have done is they have offered their balance sheet via key money to incentivize that owner to convert to a Marriott or to a Hyatt, but they will essentially fund sometimes all of that conversion PIP requirement.
We recently looked at a deal. I won't say where and I won't say what brand. We love the brands.
Love the brands.
We love the brands.
All of them.
But they were, because they had very little representation in that market. It was a very strong market. they were willing to give us more key money than what the PIP was going to cost
Exactly.
us, which offset the entire risk.
And so to that point, you think about it, what's in it for them? They think about signing these franchise agreements that are often longer than the life cycle that owner is going to own the asset. So they're going to generate fees for the next 10, 15, 20 years. And they're also going to get a flag in a market that is either challenging, if not impossible, to build in and create real value for their shareholders. And so you see the brands coming to the table 12 times more key money that they have outlaid post-COVID than the prior 25 years combined.
Which is a huge benefit. You got to think about this in terms of trying to build other asset classes. This kind of
the dynamic
doesn't exist, which is obviously a huge benefit for hotel investors.
And to your point earlier around like that cap, it goes back to that cap rate premium, right? There is that inherent risk, but to offset that, if you understand how to navigate, if you understand what the brands want, right? The brands, let's just be honest, I've worked for Marriott for a long time. They just want the flag. They just want the ability to put their name on the building. And in today's environment, really the only way to do that is to offer key money to facilitate a transaction. So if you can navigate that environment, that 300 basis cap rate premium is suddenly a lot more achievable.
I think like 50% of our target hotel audience hasn't been renovated for the last 10 years.
Right.
So you have very impatient capital who don't want to put any more money back into a PIP, who are ready to sell, and we're ready to pick it up and offset the majority of that risk with this key money. So it's a really wonderful dynamic that's occurring. And then, just more on just the motivation of these sellers, right? You also have, I think it's $88 billion of debt maturities coming up in the next 18 to 20 months.
Right. I mean, we just talked about the market that we're looking at is $260 billion, and there's $88 billion that's of debt maturing. That's like an insane number on a relative basis. And to your point, interest rates, many of these hotels were bought when rates were essentially zero. I mean, very close. So while interest rates have come down, they're still way above where most of these hotels were financed at. So you have this sort of perfect storm, right? Loans are coming due. Rates are still much higher than where they were when most of these owners bought. Plus, they have all this deferred maintenance. Most hotels require, depending on the brand, 5 to 7-ish year reinvestment in PIPs, which, has, again, made the industry challenging at times. So you have these owners that have all this money they have to reinvest to maintain brand compliant. Plus, they have a loan coming due. And so it's creating kind of this perfect storm of kind of forced sales or capital that needs to be reinvested.
Sounds like a pretty good time to buy hotels.
I hope so.
Okay, so shall we shift a little bit?
Yeah, let's shift.
So we talked about the macro quite a lot, why we love hotels structurally, why we think it's a great time to invest in hotels today. Let's go to the asset now and talk about some of these levers that you can pull, which you can't really do in multifamily investing, office industrial, where they're 1 year plus leases. You sign your lease and you rely on the macro to carry you to your return. Here, as we mentioned at the start, there are 3 players. There's the brand, the owner, the operator. Let's start with the brand. Let's talk a little bit about the brand conversion opportunity.
Yeah. So again, there are 1,200 hotel brands in the world. And I think the average consumer, and I would even say the informed consumer like myself, I could probably name 200 of them if I got lucky. There are a ton of brands. And so picking what brand you put on your building is arguably the most important decision you will make, because the brand determines what the type of consumer you're going to generate. But it also creates real opportunity if you understand the differences in brands, if you understand not just the type of consumer it brings, the fees relative to that, the customer acquisition cost, right? The brand ultimately offers a promise. It also offers you, the owner, an ability to acquire consumers typically cheaper than it would be if you just went independent. And in today's world, because the brands are starved for this unit growth, NUG, as we already talked about, they're really aggressive in trying to get their flags out there. And so that's not just taking an unflagged hotel and making it a flag. That's also taking a Hilton and becoming a Hyatt becoming a Marriott. Within all these parent companies, you have different types of hotels. Again, if you think about the scale we talked about, the kind of commodity up to luxury, just take Marriott because they're the biggest. Marriott has at the bottom end, they have their City Express brand, their Fairfield Inns, et cetera, all the way up to St. Regis, Ritz-Carlton, et cetera. And then you have everything in the middle. And so I think, again, just using Marriott as an example, we talk about that premium select, right? So that might be an AC, it might be a Courtyard, that compact full, that might be a Tribute or an Autograph, and they're all different. And so again, I think to your point about the levers you can pull, the decision to take a brand, to figure out brand, that lever is a one-time lever, but it carries through your entire option.
How do you keep the consumer in view? Because the consumer has no idea what you're talking about. Okay, the consumer knows
It's disheartening.
Hilton, Hyatt, and Marriott. Although you're extremely articulate, they have no idea. Beyond those 3 or 4, maybe 5 brands, how do how do they distinguish between the brand? Because you're going to go through all this struggle to pick the perfect brand. How do you think about picking the perfect brand for the consumer in mind and it actually making a difference?
Ooh, that's a loaded question. I mean, listen, I'll answer, but you travel too. I think the parent company is really important. Whether or not the consumer knows the difference between an AC and a Courtyard or a Tribute and a Tapestry, at the end of the day, consumers know Marriott, Hilton, Hyatt,
So it's about the
IHG.
distribution that you're getting as the investor.
Exactly. If you look at, again, and this is another reason why the non-luxury space is more attractive in many ways, the non-luxury consumer, about 90% of bookings are made online, unsurprisingly, and about 80% of those are made on mobile. And so, Marriott loves to talk about their Bonvoy app, Hilton talks about their Hilton Honors app. The reality is those are super important. The average consumer, although they might not be loyal exclusively to Hilton or Hyatt, they're probably both. That's where they start their search, right? They start it within those native apps. And so basically part of what you're paying for is just the ability to be featured. Then the sub
Which is
brand.
the wonderful thing about soft brands too. You mentioned a
Yeah.
bunch of those.
Oh,
I'm
yeah.
not sure you mentioned the word soft brands. You might have, but
Yeah. What is, I mean, what is
well,
a
a soft brand, you
right?
still get the backing and the loyal distribution from these big brand companies, but you don't have to call it Hilton, right?
Right.
It can be a JDV by Hyatt or
Right.
something like that. So you get all the look and feel of an independent, but with the backing of these
Exactly.
loyalty programs.
And I think to
which
your
is
point
great.
about people wanting to travel, people want to travel authentically. And so I would say there's, again, the hard brands still have a place because they represent a promise that's very clear. But then if you think about that more diversified leisure consumer, they want to feel as though they're in a authentic environment. And that's something the soft brands offer. And not to get back to the conversation around pips, but the soft brands offer in many ways more attractive pips, right? Because they don't have this specific brand standard. You have to have a look and a feel of a JDV or of an autograph. We don't have like specifics
Which is a great
necessarily.
point. Back to the deal where we don't mention the brand or the city. This particular hotel we were looking at was very kind of Americana
Yeah, yeah, yeah,
aesthetic, very
exactly.
cool, very like back in the 70s. When is Americana? I'm dating it. Whatever Americana period was. And this particular soft brand we were looking at was very Americana.
Right.
So we differentiated our bid because we were able to identify this soft brand that matched the current aesthetic of the hotel, which required a
Right.
much smaller PIP. These other less institutional, and which is why we like the space, less institutional, maybe didn't know that these other soft brands
Exist,
existed.
yeah.
They kind of used, the tapestry off of the data site. And when they looked at the hotel, they were like, these key sizes are too small, it doesn't even work.
Right.
And then other brands came that weren't the brand that we selected, and the PIP was way too high. So having a good understanding of the universe of opportunity in terms of the soft brands gives you a real leg up in terms of that PIP conversation, just generally how to create alpha
And the opportunity.
design and the opportunity.
I think to your point, does the consumer really know? In some sense, no. But the reality is the space that, the 10 to $30 million investment space, you're up against other investors, but those are also consumers themselves. And so if the investor doesn't understand the options that are out there, you can create real advantage by understanding, again, everyone knows Hyatt, but do you know JDV? Do you know Unbound? Do you know all the different brands they offer? Everyone knows Marriott. Do you know Autograph, right? And so I think, yes, there is something to be said. Does the consumer really understand the difference within each sub-brand? Maybe not. But those sub-brands also cater to different consumers, whether the consumer knows it, right? They have their own internal marketing, their sales. And so you are picking which one is hyper important.
It is important. And I was just thinking about multifamily for a second and condo development. All right, this is very similar to picking your interior designer.
Sure. Yeah.
Like, I'm going to pick Robert Stern or I'm going to pick a Tony Ingrao to build my lobby because I think they give us a differentiated taste and they're going to improve our sellout, right? And
Does the consumer know that?
I think when you get to a certain level, they know it, but there
Right.
are plenty of smaller, brilliant interior designers that the consumer wouldn't know. But nonetheless, they provide this incredible aesthetic. When you walk in, you're willing to pay a premium, right? So I think in a way, this is the same as that and gives you an opportunity if you know the universe to create alpha out of the gate via this differentiation. I was thinking about Graduate.
Yeah,
Soft
that's a great,
brand,
yeah.
right? It works like these university college hotels. It's the perfect brand. You go in like a University of Texas, like football
Right,
shirt,
they have the
everything,
themed
the
rooms.
Longhorns and the
Yeah.
theme rooms, and You could say if that's nice or not nice or not. But I think for a bunch of investors, they see this as a real opportunity to create a difference where maybe before with the hard brands, that kind of differentiation didn't exist.
Definitely. And I think, again, consumers, even in the hard brand space, they want some level of differentiation, right? Their business traveler is typically still looking for location, price, and whatever their company says they have to stay at. The group traveler today, the group traveler is very different from the group traveler of 10 years ago. Outside of your massive conventions, group travelers behave much more like leisure. They're there often to experience the city, and the hotel should be an extension of that. And then leisure travelers is by far the most differentiated. They tip by and large, and you see it through surveys, you see it through action. Consumers want to stay in places they feel connected to that community. And so I think even the hard brands have had to find ways to be more adaptive. But you're right, the consumer might on paper might not know the difference, but they walk in and they know.
So is there ever a good time to own an independent? Obviously, it's an independent's cheaper, right? So I guess is the argument for an independent if it has that cachet, if it has that cachet of a soft brand to the extent that it can carry the distribution itself, or its marketing speaks for itself and pulls in a consumer base itself without that, Marriott, Hilton, Hyatt loyalty program, then is that when you're comfortable going independent? Or like how would you...
Listen, I think there's still a space for the independent. Right. There are some very iconic independent hotels out there that are extremely successful.
But are there iconic premium select service independents out there?
Very few. I mean, I'm sure there are, right? At 65,000 hotels, I'm sure there must be. Sure. I think we have to the calculus you have to do when you're looking at an independent versus a brand is what's your consumer acquisition cost, right? Even if you assume you can get to the same occupancy level and even the same average rate level, which I would argue is an unfair assumption, but let's just, for the sake of argument, you can. What's it going to cost you to get there, right? A reservation booked by a customer on Marriott.com is effectively free. You pay Marriott a franchise fee, let's call it 7%, but that actual reservation is free. Marriott also has better relationships with the OTAs, online travel agencies, Expedia, Booking.com. So you pay about half as much commission. You don't have to have your own marketing engine. Part of your franchise fee goes into that. So I think you really have to figure out is, again, even if you assume you can get to the same occupancy and rate, how much are you paying to get there? And then I would make the argument, the reality is that unless, again, you're in a location where there are very few hotels, it's a true destination, and so you don't have a tremendous amount of competition, how are you actually going to get to that same level of occupancy and rate, particularly take a leisure environment, the middle of the week, right? Most midweek travelers are business travelers, and the brands offer that differentiation and that opportunity for businesses because they have these big negotiation engines.
Can I just highlight for a second on the luxury side, you don't get this opportunity for brand conversion.
Right.
So like that's just another lever you have in this premium select service space.
I mean, it's a good point, right? Ritz-Carlton, having worked there, they signed 70-year management agreements. Right. I mean, and you can terminate them, but the fees to terminate are tens, if not hundreds of millions of dollars. So once you sign an agreement with a luxury brand, you're kind of in it forever. Now, ground up is obviously different, but as we talked about, there isn't that much ground up. So yeah, I think when you look at the opportunity that brands offer vis-a-vis an independent, with very few exceptions, and there definitely are exceptions, brands offer cheaper customer acquisition and they offer distribution that the independents frankly can't get to. Even the best independents pay a tremendous amount for marketing. They pay a tremendous amount for sales. And all that said, the likelihood of getting to the same occupancy and rate levels is limited.
So that's why we love them.
That's why I love them.
We like independence, conversion to a soft brand. We're saving the marketing cost was probably this. I mean, yes, the franchise fees, etc., are more expensive, but likelihood is the independents overpaying for their marketing anyway, and then you're getting that uplift in the loyalty program, the reservations you're booking,
and to your point early on around hotels. One of the counterpoints to hotels always is during a downturn they're hit the hardest. Independents are hit the hardest. If you look at hotels as a spectrum, you have hotels broadly, and independents are by and large hit 60 to 70% harder and recover about 30% slower. Again, because their only reliance is to increase their marketing spend. And depending on where they are in the world, how are they going? They're competing against, Marriott has a $100+ billion market cap, right? They're competing against these behemoths.
Would you say a lot of these independents are also owner operated?
Almost all, right? They're typically long-term holds.
Which is another advantage, right? To convert, bring in a third-party manager who maybe can have some cost efficiencies and access to the other hotels in their portfolio they're managing, draw on those cost savings, cluster savings, and provide uplift on the NOI there.
Well, maybe talk about, that's one of the other levers is the operator, right? We've talked about the brand, but like what, you mentioned owner operator, like what does that mean, and what do the operators bring to the table?
From an owner operator, it means the same person owning is the
Same person operating.
It's
yeah.
the same
But,
operating, which can be an advantage if
Sure.
you're able to operate the hotel with decreased staffing and still provide an effective product and a desirable product. I think where it hurts is that I think there's a temptation, or what often occurs is that these hotels are understaffed and compromise the product.
Right.
Right. Whereas we bring in a third party manager, you're paying a little bit more in the fee, but you're making sure that the product is adequately staffed, that you can maximize your rate and you maximize your occupancy. Often with that, right, you get a revenue manager who
Right.
can make sure that your rate and your occ is finely balanced throughout the year. You can speak more about that, your long, illustrious careers as a revenue manager. But essentially, the third-party manager gives you the security and peace of mind that you're getting, one, hopefully the cost savings for that third-party manager managing several
Multiple.
buildings in the local area. They know the local area. They can save money on back of house, some of those efficiencies, but also bring in these third-party capabilities that help you to maximize your rate line.
And I think that one of the key pieces there is having a third-party manager that has experience in the same market, right? Because the efficiency piece on hotels, the reality is that hotels are operating assets. And in the space we're talking about, again, luxury requires 3 or 4 staff for every guest room. The space we're talking about is typically kind of closer to 1 or even maybe 3/4 to 1, but it still requires a lot of staff. A lot of the staff is what we'd call back of house, right? So your accounting, your HR, your revenue management. And if you have the right third party that has other hotels in that same market, that can be clustered, right? So instead of having a director of HR for 1 hotel, you have a director of HR for 2 hotels. And obviously, then you can split that cost in half.
There is a conflict. Let's talk about the conflict a little bit between us and the owner, as the owner and the third-party manager, right? We create money off the bottom line. Third-party managers create money off of gross revenues. Brands create money off of revenues. So there's this inherent tension. So there's extremely important why I think we're set up quite nicely given experience as asset managers, both me at the Equinox Hotel and you having done it for a long, long time in being able to asset manage these third-party managers. So we're getting all of the efficiencies that are promised to us by the third party, and that they're not overstaffing, and we can look at the P&L and say, hang on a second, you have 17 people working the bar on Friday. I was there having a drink and there were two other, we should have 1 person working the bar. So I think there is an inherent tension. They're there to maximize gross. Of course, they do make it typically an incentive management fee too, of more of a GOP or NOI basis, but even then, that's typically can be a threshold that's hard to hit, and they're focused on the top line. So there is that inherent tension.
Right? Yeah, exactly. And I think it goes back to that kind of relationship, right? Ownership, operator, brand. You have to understand what each is incentivized by, and the reality is 2 of those are incentivized by top line. And then how do you create the right mechanisms in place such that you are ultimately driving profit? And I agree. I mean, hotels are variable businesses, so you should be varying your staff based on occupancy. And your fixed staff, how can you create efficiencies without compromising the product? Because at the end of the day, again, it's a consumer business. Consumers are booking your hotel based on some sort of promise. So you have to be able to deliver, but on the backside of it, you have to know what are the levers you can pull and make sure you have efficiencies.
And I think we're going to talk about this on our next episode, so I don't want to talk too much in depth, but technology and AI is really going to help with making sure that we can make those decisions as quickly and as well as possible. I think that kind of
I think we hit a lot of points.
bring us to the end. I think we've clearly, hopefully, articulated why we love hotels so much. I mean, why we love them structurally. We don't think it's an issue that the rates reset every day. We think it's a massive opportunity. We think there's an extremely favorable supply-demand dynamic in the market right now. We think there are a lot of motivated sellers in the market right now, both because of upcoming debt maturities and these hold cycles that have been set 5 to 10 years where LPs need to recycle capital because they don't want to put in PIP money. And we're okay putting in PIP money because of key money, the availability of liquidity in the market, the debt markets are waking up. I think it's a great time to buy. So I think there's a confluence of these factors that I think position ourselves really well to launch TBD Companies.
And I think too, we talked about it, right? People always knock hotels because it is complex. But I think to your point, we talked about how if you understand what a brand wants, what an operator wants, and how to leverage those and pull the right levers, understanding all the opportunities today, it really can create real opportunity. And hotels are already priced at a higher cap rate. Again, if you can find the right deals, the right motivated seller, I think, as we've discussed, we can create a real alpha in the market.
That's great. Well, thank you. Thank you very much, Zach. So we're going to do this once a month.
Yeah.
I don't think this will change, but we're planning to talk about tech in the next episode. We want to talk about how important AI and tech is in our platform.
Yes.
We want to integrate an effective tech stack day one into the hotels that we own because we think there is a lot of value that can be delivered through the integration of that technology. And then more broadly, we're just going to talk about tech in hotels and how we need to use it.
You need to use it. I mean,
The
hotels
industry needs to
are,
use it.
hotels are famously antiquated with their tech. And
Right.
so there is obviously AI is the buzzword, but there's so much opportunity, whether it's operations, investments, and kind of everything there. So I think it'll be a good discussion.
And I know you love this stuff. You're a total nerd about the tech stuff. So bring your A game
Hardly.
as you've done today.
Always.
And thank you very much for joining. And I look forward to doing 1,000 more of these.
I can't wait. Awesome. Thank you.
Thank you.